Hello, everyone, and welcome to Thursday Talks with Chuk. Each week, we cover pressing topics that matter to you and your business. My name is Arianna Gonzalez from Chuk Attorneys and CPAs, tuning in from our San Diego office. Please join me in welcoming CPA and Tax Senior Advisor Sanika Gore and Senior Tax Accountant Subbalakshmy Ganesan from our Santa Clara office. Hi there, Sanika, and welcome.
Hi Arianna, thank you for the introduction. I'm Sanika Gore. I'm a CPA based out of Chug office in Santa Clara. Today we'll discuss changes in business tax provisions which are introduced by the One Big Beautiful Bill Act. Big changes are coming and your businesses needs to be ready. So let's just dig into the topic.
Absolutely. Thank you, Sanika. Just a quick disclaimer before we get started. This conversation is for informational purposes only. It does not create an accountant-client relationship. So if you do have questions, please comment them below or email us anytime at info@chub.com. So Sanika, can you tell me what is OBBBA?
Yes, so OBBA stands for One Big Beautiful Bill Act that was passed on July 4th, 2025 by Congress, marking a significant overhaul in the US tax code. So this legislation permanently extends provisions of 2017 TCJ, that is Tax Cuts and Jobs Act. It introduces new tax incentives and modifies its government spending. So, with an estimated cost of $5 trillion over 10 years, it offset by reductions in federal programs and elimination of various green energy tax credits from the Inflation Reduction Act. And this act ensures the tax system avoids reverting to 2017 rules.
Can you tell me what is the new qualified business deduction under the OBBA?
Yes, absolutely. So this QBI deduction is now permanent. OBBA Act removes the sunset provisions that would have expired it after 2025. This act increases the income thresholds at which the QBI deduction begins to phase out. For example, for individuals filers, the phase-in threshold increases from 50,000 to 75,000. For joint filers, it increases from 100K to 150K, and these ranges will be obviously indexed for inflation starting 2027. A new minimum QBI deduction of 400 is introduced by this act for the taxpayers with at least $1,000 of QBI from active trades or businesses in which they materially participate. Act also expands access to deduction for owners of SSTB, which is specified service trade or business. Businesses such as law, healthcare, consulting by increasing income limits before the deduction is fully excluded.
So, can you tell me how did the One Big Beautiful Act change R&D cost treatment under 174?
It significantly altered the treatment of research and development costs under Section 174 of IRC, that is Internal Revenue Code. So prior to 2022, businesses were required to capitalize domestic R&D expenditures and had to amortize them over the period of 5 years. But with this act, effective for the tax years beginning after 2024, it reverses this requirement and restores the option of immediate expensing for these costs. It means businesses can now fully deduct domestic R&D expenses in the year in which they are incurred. Businesses also retain the option to elect to capitalize domestic R&D expenditures and amortize them over the period of 5 years, beginning with in the month in which the benefits are realized. And unlike the domestic R&D costs, foreign R&D expenditures should still be capitalized. There is no change in the foreign R&D expenditure amortization. It has to be amortized over a period of 15 years.
And what about the 100% bonus depreciation? Is that still available?
So 100% bonus depreciation is also significantly altered by this act. Basically, it altered the treatment of this depreciation by making it permanent and expanding its scope. The major change is permanent nature of this depreciation, providing a long-term certainty for businesses and investing in eligible assets. So it permanently reinstates the 100% deduction for qualified property placed in service after January 19th, 2025. A temporary provision also allows for 100% depreciation for qualified production property. And this specifically applies to non residential real estate used in manufacturing, production, or refining under certain conditions related to construction and service dates.
Wow, really interesting information there. So, how does that affect provisions of Section 179 expensing? Do we have any information about that?
The maximum amount of business can a business can expense under Section 179 was basically raised from $1 million to $2.5 million, and the total cost of property placed in service during the year at which the deduction begins phasing out was also increased from $2.5 million, obviously subject to inflation adjustments, to $4 million. And the definition of Section 179 property was also expanded to include improvements to the following non residential building systems, such as qualified improvement property, roofs, HVAC systems, fire protection and alarm systems, and security systems.
Got it. Can you tell us if there's any impact on the QSBS benefits under this One Big Beautiful Act?
Yes, so QSBS benefits are also changed. So previously, a 5 year holding period was required for any gain exclusion. But now, with this act, it introduced a tiered exclusion for stocks issued after July 4th, such as 50% for the stock held over 3 years, then 75% for stocks held over 4 years, and 100% for over 5 years. This change provides a greater flexibility and it may encourage investments in startups with shorter anticipated exit timelines. The previous maximum excluded gain was limited to $10 million or 10 times the taxpayer's basis. But for QSBS issued after July 4th, Act increased the dollar based cap to $15 million with an annual inflation adjustment starting in 2027. Also, the corporate gross asset ceiling rises from $50 million to $75 million. These changes apply to stocks issued or acquired after July 4, 2025. Basically, this change allows more companies to qualify for QSBS status and potentially remain eligible for longer time as they grow.
Wow, good to know. So, can you tell us how the business interest deduction under Section 163J is affected by all of this?
Yes, so Section 163J is also significantly impacted with the introduction of this act, basically by altering the calculation of adjusted taxable income. For the tax years beginning after December 2024, Act permanently restores the calculation of ATI based on earnings before interest and tax, depreciation, amortization, meaning this act permanently restores the ability to add back depreciation, amortization, depletion when calculating uh, adjusted taxable income. Previously, beginning in 2022, these deductions were excluded, meaning ATI was calculated based on EBIT, thereby making the limitation more restrictive by lowering the amount of ATI and therefore limiting the amount of deductible interest expenses. But this shift to computation of ATI generally allows businesses to deduct a greater portion of their business interest expenses. And also, the small business gross receipts threshold was raised from $30 million to $31 million for 2025 onwards.
Are there any changes in the global intangible low-taxed income?
Yes, we generally refer this as GILTI, that is Global Intangible Low-Taxed Income. So basically, Act renamed this GILTI as Net CFC Tested Income, which is NCTI. The net deemed tangible income return that allowed a 10% return on qualified business asset investment to be excluded from GILTI is now completely eliminated. This means all of the income, including the income from intangible assets, is subject to tax. Also, Section 250 deduction that applies to NCTI is permanently reduced from 50% to 40%. The effective corporate tax rate on NCTI increases from 10.5% to approximately 12.6% without even considering the foreign tax credits. Basically, in the essence, this act aims to increase the tax burden on US multinationals' foreign earnings by broadening the tax base and increasing the effective tax rate and making changes to the foreign tax credit rules.
Wow, lots of great information so far. So, considering all of these recent tax changes, are there any business planning tips, tax planning tips that you can give for any businesses just in general with all of these changes?
Yes, absolutely. So, this OBBA, One Big Beautiful Bill Act, introduced several changes to the tax code that new businesses or even existing businesses can leverage for their tax planning. Businesses can accelerate their capital investments to take advantage of this 100% bonus depreciation that we talked earlier. They can even take advantage of immediate R&D expensing for developing new products. Also, they should review the eligibility for QSBS and QBI deductions to minimize tax liabilities, ensuring compliance with the updated criteria. For qualified business income deduction, please verify W 2 wages and qualified property to maximize the deduction, especially for SSTBs benefiting from higher phase out thresholds. Also, businesses, those have international operations, can analyze the impact of GILTI foreign tax credit changes to optimize the global tax strategies. Businesses should adjust their plans to account for elimination of green energy credits that we will talk shortly, and by exploring alternative cost saving measures.
Absolutely wonderful information. Thank you so much, Sanika. We'll go over to Subbalakshmi for the rest of the questions. So, Subbalakshmi, can you tell me how are the individual tax brackets affected?
Yes. So the individual tax brackets has been a continuation of the 2017 Tax Cuts and the Job Act. So this is an extension. This new bill is an extension of the same act, which made the tax brackets permanent. So right now, the same follows. The seven tax brackets still is made permanent. So the tax bracket will be between the 10 to 37%. And this creates a long-term certainty for both individuals and businesses when planning income strategies, retirement withdrawals, and estate planning. And also, this is beneficial for the high-income earners because previously, before 2017, the tax brackets used to be 39 percentage for the high-income earners. So right now, it will be maximum to 37%. So this is going to be permanent as per the new bill.
Oh, wow, good to know. So, what about the state and local tax deduction? Are there any changes in that area that we should know about?
Yeah, there's a significant change in the salt deduction. So the cap has raised from $10,000 to $40,000 in 2025. So which is a major changes which is going to be beneficial for a lot of taxpayers. And there will be a 30% reduction for adjusted gross income over 500K. But in specific for taxpayers in high income tax states like New York, California, and New Jersey, this is going to be benefited with the increase in the cap for state and local tax deduction.
Wow, got it. So, what about the changes to the green energy tax credit? Can you tell us a little bit about that?
Yeah, so this is another significant changes, which is also time sensitive because there has been a lot of changes in this area of this credit. The all of this, most of the credits are getting phased out this year, so we have to act immediately on this credit. So first, I'll talk about the clean vehicle credit. So the tax credit for purchasing new and the used electric vehicles have been terminated. So buyers who acquire a qualifying vehicle must do it before September 30, 2025. Only they will be eligible for this credit. So this credit is like $7,500 for an electric vehicle, so which is going to be completely removed from this year. And the next one is the residential clean energy credit. So this credit also, which applies to the renewable energy installation like solar panels, which was previously set to expire after 2034. but this is also getting terminated this year. So everything in if you are planning to install solar panels, you have to do it before December 31st, 2025. After that, this credit also will be expired. And the next one is the energy efficient home improvement credit. So same applies to this credit as well. So this applies like if you are doing any new window, doors and installation, this credit will not be longer available if your installation is after December 31st, 2025.
Wow, some important dates coming up there. Thanks for mentioning that. Can you tell us anything about senior deduction and personal exemptions?
Yes, so the personal exemption is permanently eliminated. So this was already been eliminated in 2017 as per the TCGA Act. So the same is continued in the new act as well. But in that place there is a $6,000 deduction for taxpayers who are aged more than 65, and this is available from 2025 through 2028. So this will allow them to take an additional $6,000 deduction if their income is less than 150K. So it's a modified AGI if it is less than 150K for joint filing and 75K for individuals, single filers.
Wow, really important there. Thanks for sharing that with us. So, what about the child tax credit? Is that increased? What does that look like?
Yeah, so the child tax credits also has increased. So it has been permanently increased to 2,200. Earlier, like it was 2,000. It has increased to 2,200 right now. And also the refundable credits has been increased to 1,700 to 2025. And kid with a valid social security number can take this credit.
What about the new deductions for earned income? Do you have any information on that you can share with us?
Yes, Ariana. There are few recent new deductions that have come up for earned income. So the first is the tips deduction. A deduction of up to 25,000 for cash tips is available from 2025 to 2028. So all the individuals who have received the tips, they can take a deduction up to 25,000. And there is also a phase out limit for this, which is like 150K for single filers and 300K for joint filing. So it will phase out after their income crosses that limit. And the next one is the overtime pay deduction. So this is also another deduction which individuals can take for joint filers. They can take up to 25,000 deduction, and for single they can take up to 12,500 from their overtime pay.
Wow, good news for those in the service industry, especially too. So, can you tell us about the auto loan interest deduction? What is that?
Yeah, so this is a new loan interest deduction that we are getting from this year. So, according to the new act, it introduced a temporary deduction that allows eligible taxpayers to deduct up to $10,000 per year in auto interest loan. So, this is available for both taxpayers who are itemizing as well as taking standard deduction. The rule that applicable here is the loan must be originated after December 31st, 2024, and the vehicle must be new, and it must be for the personal use, and it must be assembled in the United States.
So, is there any change in charitable deductions?
There is another change in the charitable deduction. So earlier, last year, only itemized taxpayer can take deduction for charitable contribution. So for this year, even standard deduction, who are opting for standard deduction can take this deduction. So it's allowable like $1,000 for single filers and 2,000 up to $2,000 for married filing joint.
Okay, good to know. So, can you tell us what is Trump accounts for newborns? What does this mean? What is this? Any information on that?
Yeah, so this is a new act that was passed. So this is called the Trump Account for Newborns, which refers to a new program which was established by this new act, which says all the American children born between Jan 1st, 2025 till to December 31st, 2028, they are going to receive a $1,000 contribution, which they are eligible to contribute to a invest that money into a low cost mutual funds or exchange traded funds and US stock index such as S&P 500. So they will receive this $1,000 which they need to invest in these funds. And on top of this, there are other contribution where friends and family can contribute up to 5,000 annually to this account. And even the employers can contribute up to 2,500. And the kid is access to get access to these funds only when they turn 18. This money can be used for their higher education or starting a business or purchasing their first home.
Wow, so much great, very important information today for both businesses and individuals. Thank you so much for answering all of these questions for me, Subbalakshmi. Really appreciate you taking the time.
Yeah, thanks, Ariana. So just wanted to mention that this most of these acts are like comprehensive, which are time sensitive, and we need to act immediately. So this makes it an ideal time for our clients to review their financials and strategies. So our team is always there to help them and make sure that we make sure that we can use most of the opportunities available to them.
Absolutely. If you are watching this and have any questions about this, if you need help with us breaking it down for you, please reach out to us anytime, info@chuk.com. We'd love to help you out. Thank you, Subbalakshmi. Thank you, Sanika. So that is all we have time for today. Thank you everybody for joining us. To stay up to date, please subscribe and follow us on Facebook, LinkedIn, and YouTube. If you have any questions or suggestions, please feel free to send us an email anytime at info@chuk.com. Let us know what topic you want to see next, and make sure to join us back here next week for more pressing topics that truly matter to you and your business. Until next time, stay safe and take care, everyone. Thank you again for joining us.